My name is Samuel, an investment analyst with Phillip Futures, and tonight I'll be covering on the opportunities amid trade tensions and the hawkish Fed. So before we begin, just a little disclaimer is that anything said today will be solely for education purpose and does not constitute any form of financial advice. So before you make any investment decisions, please consult your relevant investment consultants and please do your due diligence. So a little bit about myself. I'm an investment analyst with Phillip Futures. So I specialize actually at the equities, indices, and forex markets. So on a day-to-day basis, I actually provide daily commentaries on the indices and forex. I'm also a market commentator, so you may have seen me on the news, if not heard me on the radio, or maybe seen my commentaries on the newspaper before. I also give seminars. So some of the largest scale seminars I've given is the Invest Fair last year, as well as the Lianhe Zaobao Forum this year itself. So just a little seminar outline. This will be actually about the major global themes which have affected the market so far. So we are mainly focusing on the US market, and we will actually cover it in this format. Firstly, we'll actually do the overview for the first 3 quarters of 2018. After which we'll do the forecast as well as views for the last quarter itself. And lastly, how to partake in market action using futures. So we'll be covering both the indices futures as well as the currency futures. So this seminar could actually be conducted with special thanks to CNE. So going forward, I'd just like to ask everybody, how do you think markets is right now? So ever since we saw the peak 2 weeks back, many are wondering what's next. Are we going to edge higher, or actually we are going to slip into a bear market? So personally, we have the view that actually, so long as you have a view, you don't need to be scared, because if you are one which are just following the main masses, you'll be known as a sheep. And if you are a sheep, there's a high chance you'll be trapped inside having no view, and you'll be trapped, and high chances you're going to get slaughtered. So how about us? We have the view that right now we are in the last stretch of the bull market itself. So we note that this bull market has been ongoing for very long, but if we are looking at the last stretch, it's usually going to edge slightly higher, but it may slip into a bear market anytime soon. So we must understand the main fundamentals of things that are actually moving markets. So we are looking at the major global themes that most markets are reacting to, not aside from just the US market alone. So the first one will be the trade and global tensions, which has been dominating many news headlines of late. Next will be the rising interest rate environment, and finally, the emerging market crisis itself. So we all know that right now, US and China trade tensions are escalating. Aside from the three waves of tariffs that have already been implemented, President Trump has actually gone harder on China. So we can see that just this quarter alone, as in the third quarter of 2018 alone, 3 waves of tariffs actually were implemented on China. First in July, then in August, and lastly in September. We note that the third wave, which was the one in September, actually is the most impactful because it's actually more than the first and second wave combined together. And we also note that it's actually targeting Chinese consumer goods as well. So going forward, should the fourth wave be implemented, is actually more disastrous to global markets. Because why? We note that with the first 3 waves, we already see that globally, economy has started slowing down, especially in China. If you look at the latest GDP results, we can see that the impact of the first and second waves of tariffs alone is already slowing down GDP growth by around 0.2%. So should it escalate further, if China's growth actually slow down even more, it may impact global economic growth. So how about the fourth wave? Well, we all know that President Trump has indicated that he's going to implement a fourth wave of tariff. It's just that we don't know when. So what happens is that the fourth wave, it actually targets all Chinese goods that are actually entering the US. So if the fourth wave were ready to be implemented, market jittery will be there. But one thing to note about the third wave is that the third wave is actually split into two parts itself. So we note that right now, the up till this year is only 10%, but after next year, it will be worse, it will be 25%. So a lot of speculation is that it's because the midterm elections is fast approaching in approximately 2 weeks' time on the Deepavali day. So we note that if that actually happens, what will happen is that uh, because of the midterm elections, President Trump do not want the voters to be that angry with him, and therefore he do not want to increase Chinese consumer products by too much first, because if not, they may vote against him, and he may not be able to retain majority in the House and Senate, and hence, we note that this has resulted in the tariffs being split into two parts. So should the second part of the tariff come in, what will happen is that the economy may slow even further. So the fourth wave itself actually has been stated many times before. President Trump recently just emphasized on it once again. So we have to wait to see if it really were to be implemented, because once it is, markets may face an round of sell-off. So we can see that the tariffs in place right now, we note that from the 1st January onwards, a huge amount of tariffs will be placed. And if the fourth wave will be placed, basically it's all Chinese products. So all of this is quite scary, because what happens is that China does not produce everything and send to the US. China actually takes a lot of intermediary parts from the rest of the world. So if demand for Chinese products actually slows, what will happen is that the demand for global products will slow as well. And this will actually cause the global economy to slow down. And we note that in the long run, this problem will not be solved easily. Why? It's because the main fundamental issues still remain unresolved. So we can expect that the trade wars will go on for quite a long period of time. So people may ask, what's the fundamental issues? The fundamental issues is that there is a huge trade deficit between the US and China, of which President Trump wants to minimize it. So to reduce a trade deficit, there are two ways to go about it. One is for the US to reduce the number of imports take from China. Or number two is for China to increase the imports it gets from the US, of which both countries are not able to do so. Why? The Chinese government, or actually China itself, wants to increase the imports from US. But what does it want? It wants actually high technology products, of which the US is not willing to sell to China. Why? Because the US is afraid that should it sell this sensitive high-tech products to China itself, China is likely to it not only compromises the security. Second thing is that China may actually overtake the US as a technology hub in the long run, because it's exposed to high-tech US technology. So what does it want to sell to China? It wants to sell to China aerospace tech, as well as agricultural products, of which the Chinese have actually imported quite a lot from the US already. So it's impossible for China to keep importing these products from the US, because it will eventually result in a supply deficit, a supply imbalance in the US, in China itself, and this may tip Chinese economy of a stable growth. On the other hand, the US has a low tendency to actually reduce Chinese imports. Why? It's because China actually imports a lot of middle to low technology products to the US itself. So we are looking at things like your television, your consumer products, etc. So right now, the US is actually enjoying lower cost of this kind of consumable products. If US were to actually slow down or to stop Chinese imports, it will actually increase the cost of living in the US itself. And we all know that should the cost of living in a particular country increase drastically, it will cause unhappiness in the citizens. So when that happens, it may cause President Trump to lose popularity, and he does not want that to happen. So we can see that it's very difficult to solve this fundamental issue, and with both countries unwilling to actually choose either ways to actually reduce the trade deficits, we can see that nothing conclusive is going to be taken home from it. And you can see that trade talks has been starting from March this year, but no conclusion until now, and in fact it's on hiatus already. So we note that the US and China trade deficit is growing. You can see that it has been increasing month on month. Also, we note that if you look year on year comparison, it has been increasing as well. So this is an issue there to stay, and President Trump is trying to reduce this deficit by actually implementing tariffs. But like stated, it's going to slow down global economic growth. Many countries have actually in fact reduced their growth due to the uncertainties of this trade war, and that they expect numbers in terms of manufacturing to not be as good as last year. He has also weighed on investors' confidence in the long run because with all this uncertainty, companies are not really willing to actually go into merger and acquisition or to actually expand their business because they do not know what is going to happen to them in a few years time or even a few months time. And because of the unpredictability of the trade tensions, they they do not want to take the unnecessary risks. And so we also note that this has actually weighed on investors' confidence, and it has caused one of the recent plunge around 1 week back. And this is expected to escalate should President Trump actually carries on the fourth wave of tariffs, or if anything unexpected were to happen again. And the next point will be the rising interest rate environment. So we all note that right now the interest rate has been rising, but we must also note that there are two main key investment methods that actually investors consider. One is equities and two is bonds. So if interest rate were to carry on rising, what will happen is that it will be a matter of time whereby investors actually deem it to be more lucrative to put their funds in a low risk environment and put it in bonds because their risk-free rate is higher than actually to put it in a more risky environment like the equities because the risk to reward ratio may not be worthwhile. And therefore, we can see with 10-year Treasury rate yields rising to levels that were not seen for 5 years, around the 3.1 region, and even in fact aging higher to the 3.2 regions, we can see that should interest rate rise further, or Treasury yields even rise further, it may really capture more market interest, and share and equities may not perform that well. We also see that the Fed chairman Jerome Powell actually also stated that the Fed is likely to lift rates to levels that may restrain growth. Why? Is because the US economic numbers has been quite fantastic, and we note that the Fed is still independent of President Trump, and so despite President Trump actually saying that the Fed is crazy and criticizing the Fed, interest rates still have been stealthily rising, and we can see going forward, should interest rate rise further, there may be more downside risk ahead for equities markets, as well as the US indices and global indices as well. So the last point that is actually impacting global confidence is the emerging market crisis. We note that back in 1997, the Asian financial crisis was actually caused by emerging market currencies. And right now, emerging market currencies are back in the spotlight. Due to the rising US dollar, what it has actually resulted in is that emerging market currencies are actually weakening drastically. So we are looking at emerging market currencies like the Indonesian rupiah, the Turkish lira, and maybe even your Philippine peso. So what does this mean? Well, we must note that a lot of these emerging markets actually borrow funds denominated in foreign currency. So like example, we are looking at Turkey actually loaning from Europe, and their loans are denominated in euros. So if their currency weakens too much and the base currency actually rises, what it means is that it will be even harder for these emerging market countries to actually repay back their loan, and they may go into debt. They may go into a liquidity problem or even deficit. And should that happen, it will spark off another financial crisis. And that's why markets have been concerned that emerging market currencies aren't performing that well. And should it continue to slip or even actually depreciate further, it may spark another round of concerns from markets. So we note that right now, the emerging market route in terms of emerging market currencies has been its longest since 2008, and confidence towards emerging market currencies have reached one of the all-time low. So aside from all of these global factors impacting markets, we have to look at specific factors that are impacting the various country indices. So if we look at the US itself, we note that the US have actually 4 different major indices, of which are all actually which investors can actually purchase all of them or actually sell all of them using futures itself, because we have specific futures contract to track each particular indices which are offered by CME. So we can look that the S&P is one that is the most diversified because it's actually made up of 500 different large cap companies. So if, like example, you're looking at things across the board, S&P is more balanced. Then followed by Dow Jones. Dow Jones is actually more focused on the industrial side of things, so it's more sensitive towards your trade tensions, etc. And for Nasdaq is very tech focused, so most of your FANG stocks, etc., are focused on the are all listed on the Nasdaq, and Nasdaq tracks them. Lastly, is for people who like the small and mid cap stocks, they can look at the Russell, because Russell actually tracks the small and mid cap index in the US itself. So how has the US market fared over the past 3 quarters? We note that it has edged higher, and you can see that for the Dow, it has risen around 6.8%. The S&P has risen 8.8%. The Nasdaq, which is the one doing the best, has risen around 19%. And the Russell has rose around 10%. But why? Why is that so? It's because we note that at the start of the year, markets saw a huge boost, saw a huge confidence boost because of the fact that tax cuts were in place. But subsequently, more headwinds were seen. So you can see that he has kept the growth. One of it is that President Trump has increased his aggressiveness towards trade policies. So this has actually caused markets to be a little bit more fearful, a little bit more cautious. Also, we note that there has been a normalizing tax cut effect, and that there's still very strong growth in the technology sector. So, aside from President Trump targeting China, he has also targeted several other countries, like the EU, like Japan. So what happens is that he has been trying to forge bilateral trade agreements, and this has actually caused markets to feel more jittery because President Trump is very aggressive. So you can see that in order to avoid this kind of trade wars, countries have been forced to make concessions. And should they band together, or should they not agree to President Trump's terms and conditions, it may actually cause the trade war to escalate even further. Next, we also note that the tax cut effect has actually started to ease, because why? Investors are always very forward-looking. So we note that initially we can see that in January itself, when the first time when sort of like President Trump actually announced the implementation of the tax cuts in December last year, we note that during the January earnings season, indices actually soared. Why? It's because a lot of the companies started factoring in this potential increase in revenue, and it has actually beat analyst expectations. So this has caused markets to soar. But however, we note that this effect is actually lesser over the subsequent quarters. Why? It's because market have actually analyzed and saw that, oh, this is how much to expect. And analysts have revised their forecast, markets have revised their forecast. And even though earnings still beat expectations, the impact is not as great as the first time around, and is expected to actually normalize even further. So we may not see this huge catalyst that we saw at the start of the year, and markets may not see that much strength as well. Nonetheless, the tech sector has continued booming since last year. This year was no exception. Your FANG stocks, companies like Apple, like Google, Amazon, they have constantly continued to innovate. President Trump, by actually protecting copyrights, have actually benefited them. So all of this has actually caused technology stocks to boom even greater. And this has actually pulled the entire US indices higher this year. Nonetheless, going forward, we are actually quite bearish on US indices. The main reasons are as followed. Firstly, is that US-China relations actually have showed no signs, no clear indications of easing at all. There has been increased market volatility, and the trade tensions are expected to harm corporate earnings. So, what happens is that we have a question for everybody. Firstly, do you all think the new NAFTA agreement is good or bad for the US economy, or actually the US and China trade tensions? Well, personally, we feel that it's quite bad. Why? It's because with President Trump actually succeeding in the new NAFTA agreement, he could focus more energy on China itself, and of which the trade pact with Canada and Mexico actually prevents them from doing business with China. Because why? President Trump would like Mexico and Canada to avoid being the back door for Chinese products to actually enter the US. So with that in play, China and US tensions are going to be China and US tensions are going to be even more rough going forward itself. So aside from that, we can also see that President Trump has been holding back, and he wants to wait for more certainty to actually implement more policies in terms of going harder in terms of trade. So one of the key events to note will be the midterm elections. As stated earlier, in terms of the third wave of tariffs being split into two parts, we note that President Trump, from now to the midterm elections, may not try anything drastic with China itself. But should he, once the midterm elections is over, and should he actually retain both Senate and House simple majority in terms of the Democrats actually winning, no, sorry, I mean as in the Republicans actually winning both and retaining both the House and Senate, it would actually be one of the key indicators that President Trump is able to implement more drastic policies. And should that happen, it will actually aggravate the whole sell-off. So there are many ways for China to strike back against the US. China is actually one of the major foreign holders of US treasuries. So we note that the Chinese government have been reducing holdings of US treasuries for 3 times in a row, for 3 consecutive months. And should they actually reduce their holdings of US treasuries even further, it would actually cause market panic. Okay, so even though Treasury Secretary Stephen Mnuchin has actually stated that he is not concerned and that there will be sort of like buyers in the market regardless, but nonetheless, it will still waver market confidence. Why? It's because should there be a sudden sell-off of US Treasuries, it will cause US Treasury yield to spike drastically. And once it spikes drastically, it will cause an inflow of interest towards the bond market. And when that happens, the equities market and indices will face greater sell-off. So this is seen in history as well. Back in 2016, when China rapidly reduced its holdings of US treasuries due to internal factors, we note that US indices were kept stable despite global indices rising. So going forward, should this happen again, it may cause US indices to slump. We also note that the Chinese economy has been contributing a lot to the US side of things as well. China has a lot of the citizens have actually gone to the US to spend, to travel. We also note that the Chinese side has also invested in the US, and should relationships worsen, what will happen is that Chinese may stop going to the US. All right, this is seen whereby a few months back, China actually said that now Chinese citizens were more afraid of going to the US itself. We also note that US companies actually invest a lot in China, and should China actually restrict US investments or have more restrictive clauses in place, it will cause US companies to suffer. So there's also increased market volatility. We note that even the IMF has stated that market volatility is at all-time high. In fact, if you look at the VIX index, as compared to last year, this year we are much more volatile. So with volatility at all-time high, investors can actually consider using futures because they are able to long and short the market. But on the equity side, on the indices side, because it's more volatile, there's more room for downside as some investors may stay out from the market. But using futures, you are able to actually leverage on this as well. We also note that the trade tensions have impacted companies' revenue. So a lot of investors, even companies themselves, markets in general, are saying that this quarter earnings may not be as good. Why? It's because due to the trade tariffs, it would impact corporate revenue. Also, we note that if, like example, China were to make the business environment more challenging for US companies, it was going to impact earnings even greater. So with lesser market confidence as compared to last time, it will weigh on markets going forward. And if really corporate earnings were to disappoint, it will cause markets to sink again. So if we look at the indices futures, we can see that prices have actually found strong support at the 200 moving averages. So every time it hits the 200 moving averages, we see some form of rebound. This is in the Dow and the Nasdaq as well as the S&P, which will be shown later. But what is actually different and what we're looking at right now is that markets are still relatively bearish this time around, and the rebound is not as great as last time. So if markets were to sink and test 200 moving averages again and breaks below it, it may mean the start of a bearish trend, and it may cause markets to slip even further. So like stated, the S&P has also seen some rebound, but it's not as strong around as last time. And in fact, if we look, markets are still easing. For the Nasdaq, we are more worried on it as compared to the other indices because what rises the fastest drops the fastest as well. So we can see that the tech sector has been benefiting from the policies, and markets have been relatively bullish on it. But should earnings disappoint, especially with it being impacted by the tariffs due to the various parts involved, and if earnings disappoint, it may be the one that sinks first. For the Russell has already slipped into a bearish trend. It has fallen below the 200 moving average, but it has rebounded after testing the 61.8% Fibonacci retracement. If it fails to break above the 200 EMA, it will still remain in the bearish trend. So how about the dollar? The dollar has a very different outlook from US indices as a whole. Why? Because we are bullish on the dollar due to a few reasons. The first thing is that it's a safe haven currency. Second is that the Fed's still hawkish. And lastly is the cash repatriation plans by companies itself. So just to elaborate a little bit more on safe haven currency is that like stated earlier, markets have been volatile due to all the various trade tensions, etc. and hence markets are being more risk averse. So this will benefit safe haven currencies, and we can see that one of the safe haven currencies is the US dollar. So should more market interest go back towards dollar, the US dollar will still appreciate. Okay, then next we're looking at Hawkish Fed. So we note that the new Fed chairman is actually Jerome Powell itself. So he has been in the Fed since 2012. It's not a new face to most people, but the difference between him and Yellen is actually quite obvious. So he's much more hawkish than Yellen. During his first FOMC meeting, he actually raised the future forecast rates for the subsequent years. So it shows that interest rates may actually rise faster under his leadership. We can see that this is supported by all the recent FOMC meetings as well. So during the latest FOMC statement, we can see that the Fed has actually stopped using the words accommodative and indicated that interest rates are going to get higher going forward. He has also retained its RB assessment of the US economy and noted that the labor market is continuing to strengthen and that household spendings have grown very strongly. He also downplayed all the recent trade tensions as well as the recent criticism by US President Trump about the hawkish Fed. So once again, this emphasizes the fact that the Fed is rather independent. Moreover, 12 out of 16 members are of the view that there are four rate hikes this year as compared to what was predicted at the start of the year. So at the start of the year, they were predicting 3 rate hikes, but right now, 4 rate hikes is likely to happen. Also, they indicated that they are going to have a press conference after every FOMC meeting from next year onwards. So we note that right now, at present, the press conference occurs every bi-meeting. So during the press conference, we have note that it's a good chance for the Fed chairman to actually raise rates. Why is that so? It's because he's able to address the media and the public and to ease market fear. So should he have a press conference after every FOMC meeting from next year onwards, it actually increases the probability of him raising rates more than 4 times next year. So what happens is that Fed Chairman Powell right now also believes that the gradual return of interest rate to normal will actually sustain the US economy in the long run. And he also indicates that there will be more rate hikes ahead. So right now, we note that the US economy has been stable, inflation has been above or in fact near the 2% objective, and this has caused the Fed to have more reasons to raise rates. Fed Chairman Powell has also been relatively hawkish during his past public appearances, and he have been indicating that the economy is exceptionally bright, extraordinary, and indicated that the Fed will raise rates till it's comfortable with it and start normalizing rates as well. So we are predicting 4 rate hikes this year, and markets if you look at the Fed, the CME Fed Watch, they have also stated that most likely, in fact, 77.3% of the people indicated that there's likely to be a rate hike in December itself. So economic data has once again substantiated the rationale for the rate increase. We looked at inflation rates above 2% target based on the CPI numbers. The PC numbers, which actually exclude consumables like food, is actually close to the 2% target as well. We looked at unemployment rate is at the all-time low, more than the 17-year low. GDP growth has been increasing since the financial crisis in 2009. So, and we also looked at the manufacturing numbers has been on the increase since 2016. One interesting to note is that manufacturing numbers is one of President Trump's focus, and people actually expected it to fall after the trade tariffs were put in place because it may impact what the US is producing or what people demand for US goods due to the tariffs. But surprisingly, it has still constantly increased, showing that manufacturing in the US is still strong and that is unwavered even though trade tariffs are in place. We also note that the Fed is still relatively more hawkish than the other US banks, than the other G7 banks. What happens is that the other G10 nations also had economic stimulus. Countries like the UK, Europe, and Japan, they had stimulus as well. But US is surprisingly retracting its stimulus at a much faster pace than the other countries. So we note that right now, since last year, they actually what happens is that last year they were predicting that they are going to have 3 rate hikes this year, but the US surprisingly increased it to a high probability of 4 rate hikes occurring. Whereas the other central banks, like even the UK and Europe, they actually were more dovish. So what happens is that the UK was actually expected to raise rates 2 times this year, but right now it's only going to raise rates 1 time. The ECB, which is the Europe side, were actually going to consider raising rates in the second quarter of 2019, but right now they have actually stated that they will only consider raising rates in the second half of 2019. So all of this shows that economic numbers as well as the Fed's hawkishness is actually going to boost markets further. Whereas with regards to Japan, Japan has stated that they are still going to carry on with their economic stimulus and they are unlikely to sort of raise rates or even move away from their Abenomics or asset buying anytime soon. So this shows that the US dollar still have more room for upside as compared to its G10 peers. The last point on the US dollar is that there are cash repatriation plans by companies in place. So since last year they had the Tax Cut and Jobs Act. So during the Tax Cut and Jobs Act, what happened is that President Trump actually wanted companies to bring foreign cash back to the US. So we must note that if US companies earn money overseas, they would usually store it in foreign currencies in the foreign bank. So like example, if Apple were to sell iPhones in China, they would actually get renminbi, which they will actually store renminbi in the Chinese bank. But what happens is that last time if you want to bring US dollars back to the US, you will have to pay approximately a 35% tax. Right now, for one-time basis, President Trump is stating that you only need to pay around 8 to 15% tax. So this has actually intrigued companies, and it has caused companies to consider and may even bring back cash before the end of the year because it's only valid until 2018. So should that happen, what would happen is that there will be an increase in demand in the US dollar because it involves the changing of currency from foreign currency to US dollar. And if this repatriation takes place, it's going to cause the US dollar to strengthen further as well. And so if we're looking at currency futures, we must note that for currency, we are basing one currency on the other currency. So if you are thinking that the US dollar is going to get bullish, you have to note that you will be paired against another currency and you have to think that the other currency is getting bearish as well. So we have to look at the base and the counter currency. So like example, if let's say you think that the US dollar is going to strengthen against the euro, so what will happen is that you sell the EUR USD pair. So it will mean that you are selling the euro and you are buying the USD. So if the USD strengthens, you benefit you. So if we look at it, we have to see, and if we compare the US dollar against other currencies, the US dollar still has much more room for growth. So if we compare it against the pound, what happens is that right now the pound is highly dictated by Brexit. So we know there has been a huge loss of confidence towards the UK. Why? Because people are worried that Brexit is going to happen. So Brexit is most likely going to take place in March next year. Up to date, there has been no clear indication that Brexit is going to be smooth. Why? It's because both the EU and the UK are still stuck in negotiations, as well as the fact that they are sort of like they are still engaged in a standstill in terms of negotiations due to the Ireland border, and this has actually caused market fear. Why? It's because if nothing concrete were to be achieved by December itself, there's a high chance that a hard Brexit will occur, and this will weigh severely on market confidence, as a hard Brexit is not only going to lower business confidence drastically, it's also going to cause market to panic. So we note that the hard Brexit has a high chance of occurring at present. Why? It's because President Trump is still facing a two-front war. Prime Minister Theresa May, UK Prime Minister Theresa May is still facing a two-front war. She is actually not only facing huge pressure at home in her parliament, whereby the divided parliament has actually threatened to oust, or if not threatened not to approve her Brexit plans, but she's also facing the EU side, which has been rather stringent on their requirements for Brexit to happen, and they have been rather sort of like hard on the Ireland border issue. So with relations with the EU still strained, it will actually weigh on market confidence further. And if any drastic news were to happen with regards to Brexit, the US dollar is prone to strengthen against the pound. So if you look at the British pound futures, this is based on the CME prices. So we can see that the pound futures have actually found strong resistance at the 200 moving average, and has retraced from there as well. So right now it has broken past the 20 and 40 moving averages as well, which indicate that there is more downside pressure ahead, and so it may retrace the previous low, which is around the 1.27 regions. How about for the euro? We note that economic numbers have slowed down quite drastically for the eurozone itself. This was largely attributed due to the rapid strengthening of the euro dollar itself last year. So this has caused trade with euro not to be as attractive as last year itself. Also, the rapid growth last year was deemed unsustainable, and is weighing on overall trade in Europe this year. There's also fear, as the ECB has been more dovish than expected. So as stated earlier, the ECB plans to keep interest rates unchanged for a longer than expected period of time, and this has a weight on market confidence. Also, we note that there is the potential US-EU trade war, whereby US have been going quite hard on EU itself with regards to trade, and that there is sort of like a market crisis involving the euro right now, whereby you can see that the Italy budget is actually weighing on confidence, and if sanctions were really to be placed on Italy itself, it will cause more non-confidence in the euro dollar going forward. So if you look at the euro FX futures, we can see that prices have actually broken below the 20 and 40 moving average, and it's actually testing the previous low as well. So should it lose more strength, it shows that the trend is still relatively bearish. So what we have covered so far is that there are a few themes in place that are impacting global markets. The first is the trade and global tensions. The second is the rising interest rate environment and the emerging market crisis. So how can people leverage on it? This has actually caused more market volatility, and safe haven currencies may benefit. Things like the US dollar, your Japanese yen, and your Swiss franc, of which CME does offer currency futures with relations to these products. Also, for the US indices wise, we note that we are still bearish due to US and China relations showing no clear signs of easing, and then there's increased market volatility due to all these trade tensions, and lastly, that these trade tensions are expected to harm corporate earnings going forward. Also, we note that the midterm elections still hold a strong key, and it's a key event for people to watch out for. So after the midterm elections, should President Trump's Republican Party actually retain both the House and Senate, it means that President Trump is able to sort of like still implement more drastic policies. He may go harder on trade, and should that happen, it may actually cause US indices to decline further. For the US dollar wise, we are bullish on it because it's a safe haven currency and would benefit in current environment. Second thing is that there are cash repatriation plans by companies in place. Also, that the strong US dollar is still reflective of the strong US economy in the long run, and the US economy, in terms of economic numbers, are still increasing and still performing relatively well despite the trade tariffs in place. And lastly, the other central banks are still not as hawkish as the Fed. So, going so much into the various outlook of the markets, there's actually one way to invest in indices and currencies as well. So it's known as futures contracts. So futures contracts, they're actually derivatives. So they're derived from the underlying asset, be it the S&P, be it the Dow, be it the dollar. So they do not last forever. They have an expiry date, so it's good for short-term trades. But even if you want long-term trades, not to worry, you can always roll over the contracts. So they are leveraged. So you have a smaller capital outlay, and you are able to diversify the futures that you are actually buying. However, because it's leverage, it actually amplifies both your profits and loss itself. Lastly, it allows bi-directional trading. So if you have a bearish view, just like what we have on the US indices, you are able to do shorting. So it's unlike normal equities whereby it's very difficult for you to short the market. Using futures contracts, using indices, you're able to do so. So it lets you have both a bullish and bearish view. So for advantages of futures, it allows short selling. It's simple because you don't have to actually analyze the individual stocks. As long as you have a general direction, a macro trend, you're able to use the indices to actually, futures indices to actually aid in your trading itself. And lastly, it allows you to hedge and speculate on market action. So as stated, bidirectional lets you long and short, and you are not restricted by market direction, and you can also actually benefit from both a rising and falling market itself. So a very good example will be this is a February chart, but even if you look at what happened last week itself, whereby the Dow actually fell 1,000+ points, a few hundred points, one of the largest decline over a year. What happens is that you could actually use futures indices to short the market. So if you feel that there's much more room for downside, you can short, and at the end of the day, if you cover the position, you'll make a tidy profit. It's also simple because it actually saves the process of you doing stock picking or company analysis. So you don't have to do the top bottom approach, etc. You just have to look out for the key macro events that happen. So some of the factors that are key to forming a view for indices include the economic data releases, the valuation ratios, as well as it's news driven or any spillover effect from abroad. So it's relatively simple to actually predict the trends, to actually follow market news as compared to individual company news or company analysis itself. So, like example, if you see that the Dow tumbled over 1,000+ points from the record, what would you do? Would you actually go to do a stock pick? It's very difficult to do so because some may drop more than others, and some of the stocks may be rising even though the indices are falling itself. So if you have a general direction, if you think it's going to fall, you can actually just use indices futures itself to just go for the general direction, and it's much simpler. Lastly, it allows you to hedge and speculate itself. So if, like example, you have a stock and you are actually think that in the long run it's still going to increase, but maybe because right now it's volatile, there's more market action, more downside risk, you'll be able to use futures contracts to hedge on your current position first. Alternatively, you can just use futures contracts to speculate and make profits from there. So a very good example is if you own Amazon, and if President Trump actually tweets that he's against Amazon, etc., what would you do? So some people will say, then I would sell on my Amazon. But if you have a long-term view that Amazon is still going to rise because overall you still have a strong fundamental backbone to actually back the Amazon story, you usually would not want to sell Amazon, because if you sell it, there's a good chance you may not be able to buy it back at a lower price. So what you could do is you could actually use futures to short the Nasdaq index. Then after once you close your position, not to worry, even if you hold Amazon, because it rebounded based on this day. What happens if it rebounded? And if that happens, you may have missed your entry price again. But by using futures to hedge, you're able to eliminate this risk. So some of the futures that actually track this for particular US indices are all with the CME group. So you can see the mini Dow, the mini S&P, mini Nasdaq, and mini Russell. And CME group also offers a wide array of futures on currency. You can see like the Australian dollar futures, the pound futures, even the Chinese yuan futures. So recently, Chinese yuan was actually placed on the US watch list. So there was quite a lot of market action on that, and people can actually sort of like speculate, can invest in this using these relevant futures to be exposed to the relevant currencies. With that, I end my presentation. Should you have any queries, please feel free to contact Phillip Futures. Thank you.